Good day, everyone. My name is Joe Doherty. I'm the Director of Test Development at CX University. And myself and CX University welcomes you to our webinar, Show Me the Numbers Part 2, Bridging the Gap Between CX Measurement and Real Financial Outcomes. Each of you have joined the webinar in listen-only mode. As you know, CXU is leading the way in customer experience training. We hope today's presentation inspires you to discover additional learning opportunities available from CX University. The webinar will last approximately 30 minutes. I am now pleased to introduce CXU's Vice President of Consulting, Scott McCallister.
There we are. Thank you for the introduction, Joe, and welcome everyone to today's webinar. CX University has started a consulting practice to help customer experience professionals demonstrate that their programs deliver measurable financial benefits. We believe that almost everyone needs to do a better job of this to grow or even maintain the investment level that their company provides. In our first webinar, we focused on some of the shortcomings of the common metrics in the industry. We also discussed the key elements of a strong business case. Today's webinar will focus on one of the key issues, causality. I will be describing 3 ways to show how customer experience causes financial benefits. Let me start the presentation now. I think you will find 3 takeaways today. There will be 3 different ways to show causality of customer experience actions that are key for your customer experience business case. Of those, 2 of them must be set up before a CX program starts, which is an extra burden, but also describe a 3rd one, which is a customer level database that will allow you to do retroactive tests of customer experience programs. The agenda will start with a short description of the elements of a strong customer experience business case. Then I'll go through each of the approaches one at a time. The first one is to compare your results of your program to a baseline expectation. The second one is basically your test group for your customer experience actions compared to control group. And those are the 2s that you have to plan for up front. The 3rd approach is allows you to do retroactive ad hoc tests based on having set up a customer-centric business intelligence database. And I'll describe that approach. Then I'll also describe the other value that such a database provides a company, because that approach does require some upfront investment to create that database and move forward. So now let me start the content of the presentation. The 5 key elements of a CX business case are listed here. Most everyone in this audience is focused on the customer experience actions that you're taking. You do your customer journeys, you decide what will really make a difference for your customer bases and how to implement that. But for a business case, you really need to take the next step, which shows that those actions you've taken have caused specific customer behavior changes, and that those changes increase the dollar profits, again, compared to no customer experience activities. That increased dollar profits is the incremental return on the investment, which is the 4th element, the one-time dollar cost to implement customer experience. And a chief financial officer and the whole C-suite is looking for their investments to at least pay back or get a good return on that upfront investment. The final element that's critical is to be able to track the actual results, because in practice you are pitching your customer experience program for investment based on a forecast of what you think it'll do. But in most cases, you need to be somebody that has a program needs to show that they're set up to track the actual results to see if it really delivered what was promised. Now, what we've said is that the most difficult challenge is separating the customer experience actions from other causal factors. And that's going to be the topic today, is how to do that. once you've got all those key elements together, you do have to summarize it into an analysis to justify your investment. The common one is return on investment. And all those numbers need to be pulled together into a chart like the one I'm showing here, where you're tracking the investment, which are the red bars over your years, and the green bars, which is the profit. In this case, I'm showing cumulative profit up to that time. So in the first year, you're starting with a $100,000 investment, but you lose some money, say 10% of that. The next year, you add a little to the investment, but you're starting to get the benefits of your program. You get $50,000 of profit, which is a 42% return on investment. And by the third year, you have 125% return on investment because you have your incremental profits have more than surpassed the investment. Now that said, return on investment is one measure. Some CFOs would prefer different summary measures. Examples are net present value or years to payback, and the orange bars are actually showing the payback. The first year you're very negative. By the second year, you're closing the gap, and by the third year you have more than paid back the investment in that. So you're going to be summarizing your business case in a way like this to initially get approval and afterwards show that you really delivered. Now that said, the challenge is causation, and the trick is to isolate the causality of your customer experience actions, because there are alternative causation factors. And what I mean by that is that most or all functions in a company are trying to help the business's bottom line. A group like marketing is clearly putting out business that is hoping to raise the top line, the revenue number. And they're making investments on an ongoing basis and one-time special things to do that, and separating how much additional growth of revenue that they caused versus customer experience program is what you're trying to show. New product development is also in the same situation. They're tasked with coming up with new products that more customers will buy or existing customers will buy, and their changes in revenue are doing that. There are people working on the cost side as well to reduce costs, which improves profits, and those are all alternative causation factors. So to show the causality of customer experience, you need to really control for those factors. And I've listed here three ways we see to do that. The first is to pick a place and test your CX actions, but you've picked a place where the internal initiatives like marketing and new products will have predictable results. And therefore, when CX is added to the mix, the change in the results is the benefit. Another way is to compare similar places, and one place has the CX actions and the other place doesn't. That's a test versus control group kind of approach. And again, that one is allows those internal other causal factors to be the same in both places, so they're affecting both those places the same, presumably, and therefore any change can be attributed to customer experience. I'll also note that this approach is preferable in many ways to the showing a baseline to forecast, because there are also external factors. Competitors might do something fantastic which draws business away from your company, or they may do something really bad that essentially send more business your company's way. Again, in the second approach here, if a competitor does something, presumably it is effective in both of the places that you're doing the test in the control group, and therefore that is controlled. You've controlled those external causation factors. The third way to control the factors is to build comparison groups by groups of customers. And then you look at the customers that have been affected by your CX program, compare those to the unaffected, and can see the benefit from those. So these are the three different approaches and the rationale behind them. Now let me talk about each of the approaches in turn. Again, approach one is comparing your actual results to a baseline. So step one is to specify that test segment that you're going to use. And the factors you need to think about are that it'd be very helpful if that segment is someplace where they've been financially measuring over time, so you can see what the trend has been, and hopefully that there isn't a lot of variation. And that's the second point. You want to pick a place that the results are highly predictable, absent new changes like what you would be doing, which is adding a customer experience program, because you're trying to create a baseline that you're going to compare to the actual results. You also need to pick a time frame when you're pretty sure that no other major company programs will be initiated, and you talk to the other functions about that, because if you have a baseline, but then a new program from another potential causal factor comes in, that will make your analysis of the benefits of your customer experience program more difficult to capture. And the final thing you would like to pick for your test segment is a place where almost all the customers will be exposed to the planned customer experience activities, because basically the more customers that are affected, the stronger the effect that you'll be able to measure at the other end. And when I say a segment, examples might be a retail location that is normally measured, a geographic region or sub-region, maybe a product group. You can think of different examples of segments in your company where you could isolate this test to compare the actual the results with customer experience to a baseline without it. So once you pick the test segment, you need to create that financial baseline forecast. And what you're trying to do is create something like the chart on the right, which is a forecast of the dollar profit over time that is going to be your baseline. To do this, you really need to talk to the business unit responsible for the test segment to discuss their existing cash flow forecast and get agreement on a baseline. And you also need to agree on and understand the degree of variability that they expect. And again, you want to be sure you're looking for a segment where you expect not a lot of degree of variability. The third thought is to define expenses to include an incremental profit contribution. Defining the profit measure you want to use is a special effort, and actually, as you see on the footnote, you really should include only the expenses that are affected by the program's actions and create a profit measure that excludes other factors. That's a deeper topic, and actually it's going to be the topic for one of our next articles and webinars, and it's really too deep to get into today. But having defined how you're going to measure the profit, you really should solicit agreement from a financial officer to get them to agree up front that it's a good baseline, because you don't want to be trying to argue that later and see what's going on. Now, all that said, nothing's ever perfect, and you will probably learn some things about something that occurred during that period and need to make adjustments on an ongoing basis later, because you're going to be quantifying the incremental profit contribution as your final step. So those actual results, if you look at the chart on the right, will be the orange line, which is the actual dollar profit. You compare to the baseline, and the shading in between the red in the beginning and the green later is the incremental profit that is the return on the investment that you're measuring. And obviously you'll want to summarize that into a return on investment or other agreed upon measure. So that's the way you would approach showing causality of customer experience actions with a baseline expectation. The next approach is to compare the actual financial results of a test versus control group. And the first step of that is to define the test segment and a separate control segment. Now, what you're trying to do is find two segments that have similar profiles, and the criterion could be various ones, and they really depend on what you're doing. But they might include demographic profiles, the product purchasing mix of those areas, maybe even macroeconomic environment or major non-customer experience initiatives that you need to make sure that they're going on. They're going to be in both areas, and there might be other relevant comparisons. But the key to being persuasive about this approach is being able to make a case that your control and your test segment are very similar, and the only difference is going to be the CX activities in one and not the other. And by the way, that means you do need to be sure that you don't have the CX activity suddenly popping up in the control group, because that's the whole point. So once you specify the test and controlled segments, you need to do this very similar thing that I just described under the baseline approach, which is quantify the incremental profit contribution. In this case, you have your actual incremental profit from the test, your profit from the test segment. The blue line is the control segment, and the shading in between is the incremental profit that you're going to track and measure over a time period that's appropriate for the project. The difference then between the actual and the test control segments can be contributed to the customer experience actions. Now, two footnotes here. One is, again, choosing the right profit measure is the same challenge as I defined before. But in this case, you might have two segments that are fundamentally different sizes. And because you're going to be measured dollar profit, you'll need to do some scaling adjustments for doing the comparisons to show the dollar profit difference. But that should be relatively straightforward. And obviously, the final step here is to summarize that into your return on investment measure or whatever else your company uses. Finally, let me show the third approach, which is to compare the actual financial results using ad hoc test groups. And this is the one that you can do retroactively. The previous ones, you have to plan ahead, you have to set up, get agreement. In this case, once you have the database collecting information, you can take your activities and then do all sorts of ad hoc analyses later to get at the causality issue. Now, what would this be in this customer level database? Well, this is data at the customer level that would include financial information, what they buy, what expenses they incur by calling into customer service or doing other things. So financial information at the customer level. You'd love to get customer profile characteristics, demographics, other things, locations, things like that. You want to be tracking, getting your customer touchpoint activities and observations into this database as well. So if a customer is active at a touch point or whatever, you want to be able to record that and associate it with the customer in this database. You also obviously want to capture any exposure they have to customer experience initiatives. Now, some of those are confirmed, they're obvious. If it's a customer service new approach for your customer experience things, when they call in, you can confirm that they were touched by it. But there might be other things that have to do with one-way communications to the customer, and you have to presume that they were exposed to it. And when you do that, if you have email, you can probably do it directly, but otherwise you might have to make some presumptions. So you want to capture both of those things because you're trying in this database to see who's been touched by what CX initiative. A final point is that a lot of you do voice of the customer surveys and other kind of surveys. And the surveys are often anonymous, but for this approach, you really need to cross the line and set up a method so that you can associate their actual responses to the customer names in the database, because that'll be very important for your analyses. So step one, you've created a customer level database with this sort of information. And actually, there are two approaches that you can really do this with this. The first one is to measure the customer experience effects at the customer level. And this is in a way similar to the baseline approach, where you can track all the customers that are exposed to the improved customer service or whatever customer experience program you have, and you can look at them as a whole group, test group. You then want to quantify the change in revenue and incremental profit for all those exposed customers. So the reason this is like a baseline is you'd be looking at their history, and then if their revenue for a customer rises or changes, it's those changes that you're capturing as the incremental profit. Or if they call the customer service center less, that's a lower expense that improves profit. So you would want to quantify those changes. But then, because this is a subset, but you've made a fixed investment that you've been tracking, you really need to, depending on when you do this, you would need to, if you will, scale that up for expectations of how many more customers will be exposed to the program, and therefore you'll be extrapolating the benefits to that, because you want to capture, over time, the total amount of profit you have, because the fixed investment is a set number. Now, the other thing you can do with this database is to test it with ad hoc groups. And again, the benefit is you can do this retroactively. So you can identify an ad hoc group of similar customers, and then you're going to compare the incremental profit of the affected versus unaffected. And the cartoon on the right is showing that you're picking the customers, and then you're separating them into essentially a test group and a control group. And by having this customer level of database, that will allow you to select customers that you say are similar, and to track their exposure to customer experience activities, so that you can do this analysis. A point I'd like to make is that a lot of people are getting their customer experience metrics based on surveys, but surveys are only capturing a small percent of people who respond. When you take this approach with a customer level database, you are going to be capturing everybody that was affected by the customer experience thing, and you have all the other customers that say might be unaffected that you put in the group. So you're likely to have just much more statistically significant data points to make a persuasive business case. So that's how you put together the third approach of doing your analysis at the individual customer level. But to create that database is a significant investment, and in convincing your C-level to make that investment, it's smart to point out that there are other things that are not necessarily CX related that will benefit from having this database. There's strategic and tactical kind of things that are helpful. One classic that people don't do well enough is to identify, this database will allow you to identify your most profitable customers for special attention. It may be special efforts retention, it's preemptive work, whatever, but knowing who the most profitable customers are and when things change for them is a great alert for all sorts of functions in a company to start to take action. Another benefit beyond customer experience, that you can research and look at the individual customer levels and spot people that are buying, say, less than their profiles suggest. So what I'm saying is, as you say, here's customers, and they have a very high level of purchasing from your company. Then you look at similar customers, but they have less. You can start to drill into those and figure out, maybe they need more exposure to the additional program products that other company buys. So the marketing and salespeople and that can get some great benefit out of the information in this customer level database. And finally, a sort of future look. Is everybody's talking about artificial intelligence programs getting so great, but the answer is those need a lot of data to chew on, because they're trying to find patterns that humans aren't naturally spotting. And in this case, this database would allow you to have lots of information accumulating over time of purchasing behavior. And I would guess that some of these artificial intelligence programs that are being applied now could be applied to this database and provide some really surprising insights down the road. But that's a longer term benefit. So I've talked about the three approaches, and in summary, I'd say remind you that the biggest challenge is demonstrating causality of the CX actions, and approaches like these are really important to be able to do that. I would also say the best business case is one where you have a control group versus the test group that was not affected by the CX actions. And the reason is that you can control that, you can plan for any internal initiatives that to be the same in both groups, and it's likely that any external things that you don't control will also affect both groups. So so that any changes between the two groups are really left to being the CX that you're activating and only one of them, and not all these other factors. And that said, I will say that creating a believable financial baseline forecast, it can be a powerful tool, but it is really critical that everybody believes in the baseline, and you track things to see if there might be adjustments that you might need to make. And finally, in summary, that customer level database is something I think is really kind of the future. It'll be very powerful, and it's really the only way to be able to do retroactive analyses of CX causality, and it has additional benefits for your company that I think you could pitch in trying to get support to invest in such a database. So that's my presentation for today, and I want to thank you again for attending today's webinar. I hope you found it interesting and helpful. I realize that the analytical approaches presented today can be a lot to absorb, and that's especially true for people that haven't had much exposure to financial analysis. I will offer to have a discussion with any of you who want to explore some further questions or discuss issues that may be very specific to your company. We would love to get an initial discussion with you, and if it turns into consulting, that would be great. CX University will be continuing its series of articles and webinars, and the next topic will be about that profit measurement, how to create a profit measure that's appropriate to track the financial benefits of a customer experience program. So please watch for announcements from CX University on that. So now, again, thank you, and I'm going to turn the baton over to Joe Doherty because he has some final remarks.
Well, we have some questions, Scott.
Oh, that's right. Let's go with the question.
We have several questions. First one, many CX improvement opportunities are associated with operational changes that must be done for the entire enterprise. What are the typical CX improvements that work with this segmentation testing approach?
Well, a lot of the ones that work on cost all work very well, and in fact they're easier to do because they are you don't have to worry as much about changes in the revenue. So the key is to control for a group a test group that is getting these initiatives that are going to affect costs, and just make sure that the other group that's similar that you're comparing it to doesn't have those actions. And then as you track the cost, the difference in the cost, hopefully the CX actions lower the cost, then you have a really pretty clear business case. So for those expense-oriented ones, these approaches work very well.
Next question, is there an industry rule of thumb for how long it should take for a CX initiative test or a rollout to reach break-even ROI?
No, there really isn't. It depends. Some will be very fast, and maybe even within a year. And you've heard your stories about just such a strong result because the customer experience maybe was so bad. that just by fixing that, it had a big turnaround in the customers staying loyal and buying more. But I would expect that most of them are a multi-year time frame. Honestly, you're going to be asked to track performance, probably yearly at least, and hopefully over time you will see the trend, the building, more and more customers benefit. It reinforces the reputation of the company, and things continue to get better. But if it lasts more than 3 to 5 years, you probably everybody will have moved on to the next thing. So it really depends on the specific program, the timing that you would pick.
Next question: how do you argue against the impact of marketing or sales efforts in incremental profits? Or are you intending the test group, quote unquote test group, would be exempt from typical sales marketing exposure?
Well, again, it depends. When you're setting a baseline, yes, you want to pick something where they're not changing their program at all. The baseline will be based on them doing what they have always done. So you'll want to check with them that there's nothing that would be rolled out that would say that the baseline is no longer valid. But when you have a test or control group, even if you know that they have a program coming out, as long as it's in both the test and the control group are being exposed to that marketing program, it's a safe presumption that they will both get the same benefit or non-benefit. And therefore, when you compare the results, that has controlled for any difference between the two segments because of that alternative causation factor of a marketing program. So you're not arguing against it, you're just, if you will, seeing through it, especially with the second one. We're saying, hey, well, it moved both, but in our test segment, the customer experience actually went beyond whatever benefit the marketing program offered.
Next question: most companies are looking for immediate returns on CX program investments. Applying more agile techniques, what is the shortest time frame for programs you recommend?
Well, again, it depends very specifically on the actual activities that you're putting in place and how fast you can put them in place. So if that's a priority at your company, you want to look for something that is kind of instant, which is maybe something that is changes for every customer, or maybe even reaches out to all customers and tries to make a change and track the benefits, say, within a year. But I don't think you probably are going to have enough information in less than a year to really make your strong case.
Next question: does the control group analysis truly prove causality, or does it only prove correlation?
Well, I would argue that it is causality, because you've controlled for the other factors, and because you're measuring actual results, the profits did actually move, and that's different than causality, which I talked about correlation, which I talked about in the last webinar, where you can say, we've got our net promoter score up or whatever, and oh, look, the whole company improved its revenue or its profitability. With all the causation factors behind that latter measure, you really have to call that causality. But by creating a focused test segment and then a control segment in particular, you are tracking actual results. And if you're basically saying the only thing that was different between the two segments I picked was the customer experience thing, I think you really do have a strong case that that's causality driving it.
Next question: in any service industry, say financial services industry, it would be quite challenging to segregate multiple variables over a long periods of time to show causality due to CX initiatives. Is there any good modeling software available for it?
I don't know of any, honestly, and there is a lot of software for financial reporting And some people have software that connects a business intelligence database to the reported financial results at segmented levels. But there, I think you'd be there's no one software out there now, because honestly, particularly for customer experience, I don't think really enough people have been executing this sort of discipline of calculating the actual financial benefits. So I think you'll be finding other software either in your company or additional add-ons to make this institutionalized on an ongoing basis.
Okay, we have a couple more questions, but I'd like to remind the audience to submit any further questions they might have. Do you know of any specific companies that have been successful at this financial benefit analysis?
Well, actually, as I just said, that we've been surprised that there haven't been more companies that have done it. As we've looked at people that have reported publicly on the things, they tend not to have gotten all the way to profitability and show, the real investment and return investment and describe all of that. We actually do know of a company or two that have done some tests like this, but they believe strongly in confidentiality, so we are not at liberty to discuss it. But honestly, I think this is something that a lot more people need to do, and we need more examples and cases of people that have done this, to actually done the measures and had success or failure, if it would at least be important to show one way or the other that this kind of discipline is part of the customer experience practice.
Would it be feasible to look at a financial impact by the customer life cycle broken down by NPS promoters or detractors?
You repeat that again?
Would it be feasible to look at a financial impact by the customer life cycle broken by NPS promoters or detractors?
Well, first of all, I'm not. Well, I'm honestly not sure exactly what you're getting at with the life cycle. But promoters versus detractors, again, you're doing that on a survey, and you're really measuring with that promoter score loyalty. And if you knew the ratings and they were not. If you knew which customers in specific were giving you those scores, and you had a database to look into that and see what the actual results are, then you might find some very interesting differences. You might find that the detractors were still buying and doing things differently. So I would think the customer level database would allow you to get at that. And again, you could look at over the whole life cycle of the customer and see how that changes. But just the promoter score is loyalty, and the presumption that that's going to result in financial benefits really can't be calculated until you have a whole group of customers and you know what that loyalty score was, and then you can calculate the actual profitability. I hope that answers your question.
We have two more questions. One is, everything that I've heard sounds interesting and valuable. And who do I contact again if I need more help with our projects?
Well, actually, you can contact me. My email address is on the slide that is still up there. Or you can talk to Jean Carolfi, the Director of Sales Experience. You can email her or telephone her at the number below, and we'd be happy to take your call and see what we can do for you.
And last question, unless any other questions come in, you have described three methods to show causality. In your view, is one method better than the other? And are there other methods to consider?
Well, I think the practical one that people should focus on first is the test versus control group approach. And that'll be most familiar to everybody. I think longer term, the customer level business intelligence database will be the best and a sustainable, valuable investment. The trick is getting the company to make the investment and setting up that database and sticking with it, and making sure the data that goes into it is high quality.
Okay, I think that's all questions we have. We can wait a few seconds here in case there's any other questions.
Okay, well, Joe, while you do that, again, thank everybody for the webinar. I described earlier that we have more in the series coming up, and the next topic is going to be on that tricky topic of what the profit measure should be that you should be used to evaluating these programs, which we think will be very, very interesting for people that really want to commit to trying to show measurable financial benefits from their customer experience programs.
Sounds good. That's it.
All right, Joe, I will turn it over to you.
Okay, once again, we thank all of you for attending the webinar and look forward to your presence at the upcoming webinars presented by CX University. We ask you once again to please take a few seconds to complete the feedback form and visit our website at your convenience, cxuniversity.com, to review all CX training options. Enjoy the rest of your day and keep safe if you're getting the snow. Thank you.